Hello, my fellow investors, and welcome back to another earnings report analysis video as well as stock analysis video. And today, guys, I would actually like to go over two companies, both kind of dealing with similar things. So we're going to start off with looking at CVS. Tony has been asking about this one for a little bit, and on top of that, they did just have earnings as of the 8th, and I would like to cover them, seeing that they're very popular, especially when it comes to like a dividend perspective. And the second one that I would like to cover is AbbVie. So we're going to cover these two guys, and we're going to use this kind of free cash flow as well as take a look at the earnings to see if at the current share price this is looking like a buy. But before we get started, everybody, I would like to, say thank you to somebody who commented on my TSN video, my Tyson video, and this person, thank you so much. I really do appreciate it. I was not expecting you to do this, and I really am not asking for anybody to do this, but seeing that you were the first one ever on the channel to do this, so I'm gonna shout out, guys, the commenter by another name. That's the commenter's name, and where he pretty much just commented on the TSN video saying thanks for your videos. He also had another comment where he said, great video, glad I found your channel, congrats on the engagement. By the way, for all those of you who don't know, I am engaged now. I did propose to my girlfriend, but he goes on to say, for the second, TSN became a top 10 holding for me after listening to the November earnings report, mainly because of their prepared foods segment. The latest report certainly wasn't what I wanted to hear, but I'm still bullish for the long term. And then afterwards, he commented saying thanks for your videos, and he donated $9.99. So thank you so much. I'm shouting you out because, well, you are the first person to ever donate money in that way. I have done a couple live streams. I've never gotten a super chat, and you are the first one to ever make a super comment. I think that's what that's called, a super comment. So I'm gonna shout you out. Thank you so much. Please do not feel obligated to, send money this way, guys. That's not the objective of this channel, but I really do appreciate it nonetheless, because, well, the more comments I just get from all of you, just, it really does make me want to make more videos in the long run. So again, thank you so much. You are the first one to ever send money this way, and that's why I'm just shutting you out. So again, thank you so much. Please do not feel obligated to send over money. Like, please do not take care of yourselves before donating over here. But if you do want to, I really do appreciate it in so many ways. So the most I could do is shout you out. So thank you so much, another name. And with that said, let's get started with these analysis. So let's start off, guys, with the company CVS Health. They did have their earnings on the 8th. EPS normalized actual came in at $1.99, beat by 6 cents. EPS gap actual $1.75, beat by 14 cents. Revenue actual $83.85 billion, which is a beat by $7.5 billion. So coming over into their earnings now, please remember that this is not financial advice. Every investment is the present value of all future cash flow, and all of these earnings will be linked in the description below for everybody to read for themselves. I will not go over the entire thing, only some key points. That's why, again, do your own due diligence. Link is in the description below. So we got over here, guys, the key financial data when it comes to CVS Health, and it's actually fairly interesting. Total revenues went from $76.6 billion in 2021 to $83.85 billion in 2022. That was a change of $7.24 billion. Operating income went from $2.2 billion to $3.62 billion, increase of almost $1.4 billion. Adjusted operating income $4.15 billion to $4 billion, so that was actually a decrease by $141 million. Diluted earnings per share went from 98 cents to $1.75, increase of 77 cents, and adjusted EPS $1.98 to $1.99, increase of 1 penny. Looking at the fourth quarter highlights, two big ones. Total revenues increased to $83.8 billion, which was up 9.5% compared to the prior year. GAAP diluted EPS of $1.75 and adjusted EPS of $1.99. We covered that. Full year highlights. Total revenues increased to $322.5 billion, which is up 10.4%, absolutely massive. GAAP diluted EPS of $3.14 $8.15 and adjusted EPS of $8.68, generated cash flow from operations of $16.2 billion. Actually, guys, let me just zoom in a little bit more for that. Just realized it was a little bit hard for you guys to read. But yeah, it generated cash flows from operations of $16.2 billion, repaid $4.1 billion in long-term debt. Really interesting, the fact that they're saying this, because, well, guys, we want a company to be paying down their debt. So the fact that this was a highlight tells me that they are taking this into a really important role when it comes to how they are using their free cash flow. Now, looking into their 2023 guidance, we got EPS GAAP diluted guidance. They want between $7.73 to $7.93. And again, remember, when it came to the full year highlight, they had a GAAP EPS of $3.14. So they are expecting, you know, that's a pretty big change, going from $3.14 to $7.73 at the lowest. Adjusted EPS, they want $8.70 to $8.90, which, to be fair, they're 1 penny away even this year. And then cash flows from operations guidance range of $12.5 billion to $13.5 billion. So to be fair, they already generated that this year, so actually passed it. So that could either mean that they're expecting to go down, or the fact that maybe they just want to be within this range because they know they'll be able to get a lot more. Looking now at the CEO commentary, we got, quote, "Last year was defined by outperformance across our foundational businesses, robust cash flow from operations, and meaningful progress against our value-based care delivery strategy. 2022 was a year of progress, and we continue to build on that momentum with the bold moves that will improve the health care experience," said Karen S. Lynch, CVS Health President and CEO. So all of that is sounding really good. You know, they had a couple of issues here and there, but overall, it's not looking too bad. Coming into the calculator, we got the ticker symbol for CVS, a market cap of $118.35 billion, a P of 38.28 with a current share price of $90.07. Taking a look at this share price, guys, on the 1 year, they're down 14.05%. Year to date, they're down 3.06%. That's a rarity. And 52-week range is $84.60 to $109.69. Not 52-week lows, but they're still on the lower end. And just today, you can see that they did go up $1.11, 1.25%. So, you know, they were at like $89 at the beginning of the day. So by that logic, you know, they are not 52-week lows, but still very much on the 52-week low kind of end of this spectrum. Now, they do pay a dividend of $2.42, which is a yield of 2.72%, a payout ratio of 24.57, a 5-year CAGR of, it's tiny unfortunately, of 2.43%, with one consecutive year of dividend payment. Now, whenever I see like one consecutive year of dividend payment, I really do have to take a look at the history of this, because I don't want it to be a situation where, you know, they cut it for whatever reason, you know, unless it's like COVID related. Obviously that's a completely different story, but they cut it for like some who knows reason, and then they've just become like sporadic when paying it out. Well, taking a look at the dividend history, we can see that as of 2017, January 19th, 2017 to be exact, they had implemented a 50-cent dividend, and they didn't cut it, but they didn't increase it from 2017 all the way up to October 20th, 2021 was the last year that they had this 50 cent. And then as of 2022, January 19th, 2022, they increased it to 55 cents. So it's not like they cut it, they just remained at the same at 50 cents from 2017 to the end of 2021. Their ex-dividend date passed as of January 19th. Payout date was on the 1st of February, and they do pay their dividends quarterly. Now, based off of the current shares outstanding, this means that they pay out $3.15 billion in dividends every single year, with a 5-year average free cash flow of $8.8 billion after this dividend is paid out, of course, based off of their 5-year average. And as of their last year's free cash flow, they're still left with $10.3 billion. So that's really good to see, the fact that the last year's free cash flow after this dividend is paid out is higher than the 5-year average, meaning that they're increasing their cash flows. Really good to see. And looking at these payout ratios, we got 23.39% for the last year's free cash flow and 26.3% for the 5-year average, meaning that they could pay out this $2.42, guys, and possibly even increase it in the future. Looking at some fundamentals, starting of course with the net income, we got 5 years ago of negative $594 million to 1 year ago of $4.15 billion, increase of 798%. Obviously, the big elephant in the room here is this 5 year ago value. Why was it negative? Definitely something for you guys to figure out. But on top of that, they also had a massive jump from 5 to 4 years ago, going from negative 594 to 6.6 billion. Now, that being said, this is kind of hinting that, you know, they just had a bad year, right? Something particular happened 5 years ago, which is the reason why this occurred, which is explained by the fact that from 4 to 3 to 2 years ago, even during COVID, from 4 to 3 to 2 years ago, they were consistently increasing this. And as of 1 year ago, they came down. That's why I'm giving this, guys, a 50%, because it's just, it feels like they have their reasons for this thing to go down, right? It feels that way, but definitely please do your own due diligence when it comes to this. Looking now at the free cash flow, we got 5 years ago of $6.83 billion to 1 year ago of $13.45 billion, increase of 97% with an average of almost $12 billion. Now, taking a look at this, we can see a pretty steady increase from 5 to 2 years ago, and then a drop from 2 to 1 year ago. Again, I don't necessarily know what happened. Please do your own due diligence as to why this occurred, right? But for this reason, I'm giving this an 85%, fairly consistent, but that drop, and of course, that little bit of a jump from 5 to 4 years ago is kind of concerning. So that's why I'm giving, again, 85%. Still really solid. Looking now at the revenue, this one's looking really, really good. $194 billion to $321.6 billion, increase of 65.86%. I'm giving this, guys, a 95%. Because from 4 to 1 year ago, very consistent increases. Reason why 95 is because I didn't like the jump from 193.9 billion, or sorry, 194 billion to 255.76 billion. That's the reason why. So, and 95 is still really, really solid. Total assets minus total liabilities. With the past 5 years, they've been increasing. Small dip from 2 to 1 year ago, but honestly, not too bad. It was only a dip by around like $4 billion. They're still in the positive in the past 5 years. They've never gone into the negatives, and they never had like a massive drop. So it's looking really good. Average total assets, we get $228.5 billion. Average liabilities is $158.17 billion. Doing this difference, we get $70.4 billion. I'm giving this, guys, an 80%. Also, remember that they did announce one of their highlights in 2022 was to pay off their debts. And now that I just said that out loud one more time, maybe that explains why the free cash flow fell from 15.75 billion 2 years ago to 13.45. Maybe they used it to pay out their debt, which is, if that's the case, that's beautiful. That's absolutely beautiful. And I would actually increase that to like 100% at that point, right? Because if that's what they're using it for, then solid, perfect. That's exactly what you want to see when it comes to a company. Nonetheless, assets minus liabilities, still looking really good. Looking at the cash flow minus liabilities, this one, you know, they reached their lowest point as of 4 years ago, negative $147.88 billion. But ever since 4 years ago, they have been, you know, bringing it up. And, you know, they went down slightly from 2 years ago to 1 year ago, from negative $142 billion to negative $143.5 billion. But then again, it's because their free cash flow fell a little bit 1 year ago, right? But again, if they're using that to lower their liabilities, then that doesn't really matter. So for that reason, I'm giving this a 75. And of course, their average cash flow minus average total liabilities, it is negative $142.4 billion. Now looking at the shares outstanding, this one caught me by surprise, but at the same time, it's not looking bad, but it's also not looking good. It's okay, leaning more towards the good, but it's still okay, right? We got here 5 years ago of 1.3 billion shares to today of, well, 1.3 billion shares on the dot. So let me be more specific. We got 1.295 billion shares 5 years ago to 1.3 billion shares on the dot this year. This is a small increase on the 5 year of, well, not even half of a percent, 0.39. And from the previous year to the current year, this is a decrease of 1.66. The reason why I'm saying this is kind of is because they were consistently increasing it from 5 to 2 years ago, but then from 2 to 1 year ago, they pretty much bought it back even below the 4 year ago mark. So this is showing that they are at least putting attention into the shares outstanding and trying to keep it with an average of like 1.3 billion shares. That's why I'm giving it a 70% when it comes to this one. And when it comes to the cash and equivalents, they currently hold almost $13 billion with an average of $8.82 billion. When it comes to the overall grades, guys, we give the net income 50%, free cash flow 85%, revenue 95%, assets minus liabilities 80%, cash flow minus liabilities 75%, and the shares outstanding of 70%. Overall grade of 76%, not too bad. Main issue is that net income, and it's because of a few outliers here and there. But honestly, not too bad. 76%. If this thing, if they get their net income a little bit better, I make this a 70. This would easily be like close to 80, if not above 80. So not bad at all. So now let's find out if at the current share price of $90, which seems like it's 52-week lows, is this a good buy? So let's make revenue growth assumptions of 1, 2, and 3% into the future. Looking at Seeking Alpha's growth tab, we can see that the forward is estimated at 3.17. So again, I'm putting 1, 2, 3 for my assumptions to be conservative. For the projected share buyback, I said -1, 0, and 1. So the worst assumption is that they're going to issue shares at 1% in the next 4 years. The median assumption, they won't issue or buy back shares. They're going to keep it the same, which is a plus still. And well, for the best assumption, they're going to buy back at least 1% of shares. With these numbers, guys, and a required rate of return of 10%, this puts me at $142.55 to $156.08. Adjusting for debt, this comes down by around $32 or so to $110.51, all the way up to $123.40. With a margin of safety of 5, 10, and 15%, this puts me between $93.93 to $117.23. So, by this kind of standard, guys, this is looking like a buy. So obviously, this is just my assumptions. Please do your own due diligence. This is not financial advice. Every investment is the present value of all future cash flow. That's why I have all of these calculators available for free. Link is in the description below. It's called All Calculators Video. You guys go there, and that video shows you how to operate all the calculators. So yeah, that's essentially that. But you can see, if you believe my assumptions, again, have them make your own assumptions. 15% margin of safety. For the lowest assumption, it is $93.93. We are below that at the current moment. Might be a pretty good opportunity to buy, in my personal opinion, if you believe that they'll do 1% in the next 4 years and that they'll issue shares at 1%. Yeah, I don't know. It might be fairly decent. Again, please do your own due diligence, guys. And all I'm asking for in return is just help me grow my channel. Like, subscribe, comment. It really does help here with the algorithm on YouTube. Thank you so much for everybody who have done so far. Everybody who comments. Again, I would just like to bring up another name. Thank you again for the $9.99 on your super comment. Again, you didn't have to do that. I appreciate it, though. I really do appreciate it. But at the end of the day, the best way that all of you guys can help me is just, or help us, because it's now me and Mike, is just like, subscribe, comment. It really does help. We are 4 subs away, guys, from 2,000 subscribers. And at 2,000 subscribers, I plan on making a live stream, possibly on CPI Day, honestly. Possibly on CPI Day, I want to make a live stream addressing the future of this channel. So if you guys would like that, also I would also like to do like an AMA during the live stream. So if you guys would like that, the best way that you guys can help, guys, is just like, subscribe, comment, and share. It's really about it. So thank you very much. I really do appreciate it. I'm not going to say this for the AbbVie one. I'm just going to say it right here. So yeah, again, thank you so much, everybody. I really do appreciate it. Now, taking a look at this dividend we got, guys, well, it's not a big dividend, but putting in $5,725, this nets us an annual dividends of $153.83. Not too shabby. So that pretty much does it when it comes to CVS Health. Honestly, not bad. Really not bad when it comes to a fundamental perspective. I like what they're doing when it came to their earnings report, especially highlighting the fact that they're buying back their debt, or sorry, not buying back their debt, paying down their debt. Really good to see. Might be a pretty good investment. Of course, please make your own assumptions. And now, guys, with that said, let's jump into the second company that had earnings, and they actually had earnings today on the 9th, and that is, well, a company that is loved, and I mean loved, and I personally love them, by a bunch of dividend investors. And to be fair, they have the reputation for it because their dividend is very big, and that is the company AbbVie. This is a spinoff by the company Abbott Laboratories. So let's keep that in mind. It was a spinoff like a while ago. This isn't anything new though. So I'm just, I'm not really saying anything when I say that. But just so everybody knows that AbbVie does come from the company Abbott Laboratories. It was a spinoff. And they've been doing, they have been doing a bunch of stuff. If you guys don't know them, they actually provide one of the most known medicines in Humira. If anybody knows, if anybody's seen those commercials, the Humira commercials, yeah, they make that. They manufacture that one. We're going to take a look at their earnings report as well as to see if the current share price, is this a buy? Now, before we actually head on when it comes to AbbVie, I would like to inform everybody that when it comes to pharma companies, companies that manufacture drugs, you have to take a look at the company's pipeline because, drugs are patented, and usually majority of the earnings or majority of their revenue comes from a specific drug that gets really, really popular. In the case of AbbVie, it is Humira, and unfortunately Humira will be coming out of patent very, very soon. And for everybody who doesn't know, Humira is actually going to expire as of July 1st this year, and they're already, according to Good RX Health, they're expecting like 8 biosimilar kind of drugs similar to that of Humira. So we got here, most of Humira's biosimilars are expected to launch on or after July 1st, 2023, but the first one should be available late January 2023. So actually, Humira probably already expired right now. Like, I think they expired 2023, which is again kind of concerning because that is going to take down a big chunk of their revenue when it comes to AbbVie, because now you have, take a look at this. Look at all of these other drugs that are similar to Humira. You got, by the way, I have no idea how to say most of these names, but you got Amjevita, Saltezo, we got Hyrimoz, Hadlima, I'm not going to say that. I don't know how to say that either. Usimri and Idacio. So, yeah. Guys, this is going to damper a lot of AbbVie's revenues, seeing that, now there's a lot of biosimilar, essentially generics, right? The generics are out, these are the generics, and apparently Humira just expired this year, so keep that in mind when buying into any of these companies that provide and manufacture drugs. So please take a look at their pipeline and see if they have any new drugs coming in, what stage they're in, right? Like what phase they're in, and you have to take into account how much they're going to make from this. So you have to make a lot of assumptions as well. But nonetheless, now let's come over here into their earnings summary when it comes to Seeking Alpha. We got normalized EPS GAAP actual, $3.60, beat by 2 cents. EPS GAAP actual misses by $1.33, $1.38 is what they got. And revenue missed, $15.12 billion, which misses by $181.39 million. That doesn't mean that they did bad though. Just because they're missing on analyst estimates doesn't mean that it is bad. So let's take a look now at their actual earnings report. Of course, link is in the description below. We got over here, AbbVie reports full year and fourth quarter 2022 financial results. Reports full year diluted EPS of $6.63 GAAP basis, an increase of 2.8%. Adjusted diluted EPS $13.77, increase of 16.4%. So right then and there, let me just stop. Take a look at that. EPS diluted $6.63, increase of 2.8 from the previous year. Adjusted diluted EPS of $13.77, increase of 16.4%. These results included an unfavorable impact of $39. Okay, due to actually no, hang on, that's not related to currency. Hang on a minute. These results include an unfavorable impact of 39 cents per share related to 2022 acquired IPR&D and milestone expense. Okay, I thought it was going to be like currency exchange, but no, it was not. Delivers full year net revenues of $58.05 billion. So that's the full year, not the quarter. So just keep that in mind. Guys, it has an increase in revenue of 3.3% and reported basis of 5.1% on an operational basis. Full year global net revenues from immunology were $28.9 billion, increase of 14%, really, really good. On a reported basis, 16% on an operational basis, global Humira net revenues were $21.237 billion. Now remember, this was for 2022. this is not showing the effects after the generics came out, so keep that in mind. And then global Skyrizi net revenues were $5.2 billion. Global Rinvoq net revenues were $2.5 billion. And then they go on to pretty much go into like all their other segments. I'm not gonna read all of this, but I would like to come over here, guys, to the fourth quarter results where they say diluted EPS of $1.38. We saw this decrease of 38.9. So okay, so from Q4 2021 to Q4 2022, that was a decrease. That was a decrease of 38.9%, even though on the year it was a slight increase by like, what was it, 2.8%, right? Adjusted diluted EPS of $3.60. Well, the adjusted diluted was an increase by almost 17%. These results included an unfavorable impact of 13 cents per share for the same thing as, you know, the IP R&D. Delivers fourth quarter revenues, okay, $15.12 billion, an increase of 1.6% on a reported basis and 3.8% on an operational basis. So even though, take a look at that, even though they did not beat analyst estimates when it comes to their revenue for the quarter, they still beat as compared to fourth quarter of 2021 by 1.6%. Not a lot, but it's still a beat comparison to what analyst says. And when it comes into their 2023 guidance in the adjusted diluted EPS range, they are at $10.70 at the lowest to $11.10. Now, unfortunately, if you guys remember up here, adjusted diluted EPS of $13.77. So they're expecting, guys, to come down this year. That is kind of concerning, though. Really kind of concerning that their projection isn't that good, right? Now, let's come over here into the CEO's comments. We got 2022 was another highly productive year, capping a decade of outstanding performance. Since our inception, we have built a diverse portfolio of growth products with significant leadership positions, developed a robust pipeline of innovative assets, and created a culture of strong execution, said Richard A. Gonzalez, Chairman and CEO. Looking forward, we have a solid foundation which will allow us to absorb the U.S. Humira loss of exclusivity. There it is. I just said it right there. Return to strong top-line growth in 2025 and drive top-tier financial performance over the long term. So yeah, they're expecting, well, I mean, just right over there. Looking forward, we have a solid foundation which will allow us to absorb the U.S. Humira loss exclusivity. Return to strong top-line growth in 2025. So basically, they're like, we're going to lose from this Humira thing. Hopefully, it's not too bad. And maybe by 2025, we will be back to zero to what it was, well, prior to losing Humira. That's pretty much what they're saying there. So definitely something to take into account, guys. Not going to lie. And in fact, if we come over here to page 7, we could see how much Humira actually made up, right? We got over here, Humira, $5 billion in net revenues, just them alone. Like, Humira was majority of the revenue in the United States, $5 billion. I mean, guys, this was 9.9% as a percent change from fourth quarter 2021. So, you know, they went up massively in Humira from Q4 2021 to Q4 2022, $5.6 billion. And if you take a look at the other ones, you got Skyrizi, it's only 1.4, and Rinvoq, 566 million. So yeah, Humira does pull majority of all of them, even in the other segments. You can take a look at this. No other drug gets close to the numbers that Humira makes. So that's a major impact. Might serve, honestly, this might actually serve as a pretty good opportunity to buy AbbVie at much lower valuations if their stock falls. Once we get Q1 of 2023, and they're like, oh yeah, no, we are losing revenue. We are losing revenue because Humira is gone. So might serve as a pretty good opportunity to buy AbbVie. Nonetheless, though, something to definitely take a look at and to definitely take into account when making assumptions. So now let's actually come over here into the calculator. We got the ticker symbol for AbbVie. By the way, full disclosure, I do own this company, guys. I really do own this company. And in fact, I'm actually going to show you exactly how much of this company I own, just so that way there's full disclosure on this. So far, I own almost 74 shares for, I have invested $8,124, and they're paying me a quarterly dividend of $109.40. So the fact that I'm actually going to cover this company right now, I'm actually, well, you know what? I'm actually going to put a lot of this on my watch list and like make certain adjustments as to what price I get, because I want to keep buying this company. I really do. But, well, you guys are going to see exactly what I mean, why I haven't at the share price when we get to that point. But nonetheless, we got the ticker symbol for AbbVie. market cap of $263 billion, a P of 19.81 with a current share price of $148.70. Taking a look at this, guys, on the 1 year, they're up. Not a lot, but they're up. That's very, very rare to see. 3.84%. Year to date, they are down 8.42%. In fact, their peak, I believe, so far this year is $166.55. 52-week ranges is $134 to $175.91. Just today, after they had earnings, they went up 2.83%, which is $4.09. In post-market, they went up another 0.2% to $149. So we are pretty much like halfway between the lowest point of the 52-week range and the highest point. Now, with that said, they do pay out a dividend. This is the main reason why a lot of people love this company. They do pay out a dividend of $5.92, which is a yield, guys, of 4.09%. Massive. Absolutely massive. Payout ratio of 41.78. 5-year CAGR, not tiny. That's a massive 5-year CAGR. 16.92% with 9 consecutive years of dividend payment. I think that this is a little bit higher. I think this is misleading because they did spin off of Abbott. And I guess if you take how many years Abbott has been paying out the dividend, and then you add these 9 years, then I guess you might consider this a lot higher. But from its inception, you know, they've been paying out this dividend for 9 consecutive years, at least AbbVie, not Abbott taken into account. Ex-dividend date passed as of January 12. Payout date is going to be on the 15th of February, so just next week, and they pay their dividends quarterly. Based off the current shares outstanding, guys, and this $5.92 in annual dividends per share, they pay out $10.5 billion every single year, and as of their last year's free cash flow, they're still left with $6.78 billion, and as of their last year's free cash flow, it is $11.45 billion. Really good to see that as of their last year's free cash flow, it is a lot higher, but $5 billion than their 5-year average, meaning that they are growing. Now, these payout ratios come out to be 47.76% for the last year's free cash flow and 60.68% for the 5-year average. 5-year average is a little bit higher than what I would like, but nonetheless, it's still looking okay. It's getting really, really tight, but it's looking okay. So now let's take a look at their fundamentals. Net income 5 years ago of $5.68 billion to 1 year ago of $13.41 billion, increase of 136%. One issue here is just that, well, they went down 3 years ago, but 3 years ago was COVID, right? They do not make anything regarding COVID, so they went down that year. Now, I actually have it here as a 50%, but I'm gonna revise that because I did not think that 3 years ago was COVID. I completely forgot about it. I'm actually going to change this to like an 85% because it's an outlier year, guys. It's an outlier year, so I'm going to give it an 85%. Looking now at the free cash flow, really, really consistent, I guess you could say, though it's not perfect. We got 5 years ago of $12.78 billion to 1 year ago of $22 billion, essentially increase of 71%, with an average of $17.25 billion. Take a look at this. They did go down from 5 to 4 years ago by a couple $1 million, right? It was a little bit more than like $10 million. But then they brought it back up during COVID, believe it or not. They shot it from 12.77 billion to 16.8 billion. And then they shot it back up again from 3 to 2 years ago. And from 2 years ago to 1 year ago, they did go down a little bit. So, you know, I'm going to give them the benefit of the doubt, and I'm going to say 85% on this one. It really wasn't that big of a deal 5 to 4 years ago, and it was so far away, guys. So for now, I'm going to give them an 85%. Looking now at the revenue, this one is looking very, very good as well. We got 5 years ago of 32.75 billion to 1 year ago of 57.8 billion, increase of 76.53%. And you can see that there really wasn't any outlier like on the downside. The big outlier here was, well, 5 to 3 years ago, that was a pretty big jump, 33.26 billion to 45.8 billion. Nonetheless, I'm giving this a 95%. Looking at the total assets minus the total liabilities, though, this one, it is concerning because 4 and 3 years ago, they were in the negative, but they brought it back up to the 1 year ago by a significant amount too. So yeah, that's a little bit concerning, but as it currently stands, that's just what's happening here. Average total assets, it is $117.4 billion. Average liabilities is actually getting close to that average total assets, $111.8 billion. Doing this difference, they still have on average around $5.6 billion. I unfortunately have to give this, guys, a low grade because we have 2 years here that, you know, they went in the negatives. One's explainable, the other one you have to go looking for it. So for that reason, I'm going to say at around like a 30% or so when it comes to this one. Looking at the cash flow minus liabilities, this one's also not looking too good, but it does have promise. So they have been decreasing this in the past 5 years, even though their cash flow has been increasing. It just goes to show that their liabilities are very, very high. But as of 2 years ago to 1 year ago, their 2 year ago value was the lowest point at negative $115.5 billion. And as of 1 year ago, they brought it slightly up to negative $109.2 billion. So not too bad, but the overall trend is to go down. They've only had 1 year where they brought it up slightly. Average cash flow minus average total liabilities, it is negative $82.6 billion. I have to give this like a 35% or so. And when it comes into the shares outstanding, this one's also not looking too good. We got 5 years ago of almost 1.6 billion shares to 1 year ago of 1.77 billion shares. That's an increase of 11% on the 5 year, and even from the previous year to the current year, it is a small increase of 0.01%. Now the thing here is that from 5 to 4 years ago, they brought it down. They kept it roughly down. From 4 to 3 years ago, they increased it slightly, but they shot it right back up from 3 to 2 years ago, going from 1.478 billion shares to 1.765 billion shares. And then they slightly increased it after that. Nonetheless, though, that's a really big increase in shares, guys. I have to give this essentially like, I would say like a 30%, right? It really isn't that good. Mainly, I'm giving a 30% and not lower because they at least brought it down from 5 to 4 years ago. But majority of this, well, was done in 1 year from 3 to 2 years ago. And looking at the cash and equivalents, they currently hold $11.8 billion with an average of $14.4 billion. Looking at the overall grades, we gave the net income 85%, free cash flow 85%, revenue 95%, assets minus liabilities 30%, cash flow minus liabilities 35%, and the shares outstanding of 30%. Overall grade of 68. This is an instance, guys, that again, this is why I keep saying, do not follow what I'm doing. Every investment is the present value of all future cash flow, and this is not financial advice. I'm buying into a company that I gave it a 68%. Now, the thing is that you guys don't know when I bought that company. And I will tell all of you guys exactly what it was, though, when we get into the target share prices. But let's just say that my price target was a lot lower than what it is right now. So the fact that I'm seeing 68% here, I guess it might go against my way of investing. But in reality, it's not, because I originally paid for this a lot less. So it just goes to show that, again, every investment is the present value of all future cash flow. So now let's come into the target share prices. Let's say a revenue growth of 1, 2, and 3%. I'm getting this, guys, from Seeking Alpha's revenue growth tab, which they have in the forward at 5.9. The reason why I'm going that low is because I have to take into account Humira disappearing, right? So that's why I'm pretty much going with 1, 2, and 3%. Then for the predicted share buyback, I'm going to say they're going to increase shares at 15%, 12%, and 9% in the next upcoming years. With a required rate of return of 10%, guys, take a look at this. Not adjusting for debt, this price tag is $101.51 to $115.41. Adjusting for debt, this comes down to $78.90 to $91.46. Margin of safety of 5, 10, and 15%. This is $67.06 to $86.89. You're probably looking at this and you're like, oh my God, those numbers are so low. It'll never fall there. I mean, it can, especially now that we're going to see an impact on their revenue because Humira is gone. So keep that in mind, because if these numbers tend to be true, if their revenue increases, let's just say 2%, and they issue shares at 12%, and the stock price falls to like $100, congratulations, guys. This is looking like a buy when it comes to the median assumption. Now, here's my reasoning as to why I am not buying this company at the current share price. Obviously, these numbers showing one side of the story, but also my average share price, guys, it is $109.86. That's essentially why. So I bought this company essentially between the median and the highest assumption. Exactly. So just because my grade is a 68 for the current share price, the fact of the matter is, guys, I still bought this significantly lower. And in fact, I bought this at a point where, you know, it served as a pretty good deal. And in fact, at one point, AbbVie was like $80. You're telling me that you wouldn't buy AbbVie if it fell again down to $80? That's amazing, guys. That's an absolutely banger of a buy. That dividend would be like 7% at that point. So again, please understand that well, every investment is the present value of all future cash flow. And these numbers are telling me one thing, and it just goes to show that, well, what you pay for matters. And if I would have just bought into this company, at all-time highs, well, I wouldn't be up on this company right now $2,870.94. Yeah. Since I bought this company, I am up $2,870. Again, to all those people who say, no, you're wrong, it'll continue to go up, blah, blah. No, it absolutely doesn't have to. It can go down. That's why I'm hedging my bets, and I would like to buy this at around like the $100 mark, a little bit less than, what we got over here. I'm willing to take the L on $10 if it means I get to lower my cost basis by around $10 or so. Looking now at this dividend, because this is absolutely an amazing dividend, guys. We got a monthly income of $5,725, buying this amount of money into this company at the current annual dividends per share of $5.82. This is a massive dividend of almost $228. And in fact, let's put in here my average share price of $109. And let's see how much in dividends you would get for now this price tag if it were to fall between the median and the highest assumption. Guys, $311 in annual dividends. You're telling me you wouldn't do it? Come on. It's that. Oh my God, guys, that's so good. That's $77 per quarter. That is amazing. All right. That is absolutely amazing. It just goes to show that it matters what you pay for. All in all, when it comes to AbbVie, as I said, I love this company. I own them. I showed you guys that I own them, and I'm not buying them at the current price though. I'm not. I'm going to wait. Hopefully with these bad news when it comes to their Humira revenues crashing, since Humira does make majority of their revenue, maybe they'll be a good time to buy this year. We'll see. Keep this company, guys, on your watch list with a lot of alerts. That pretty much does it for this video, buddy. If you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow us on the YouTube sites, link in the description below. So with that said, peace out, and I'll see you all in the next earnings report analysis as well as stock analysis of video.